Hello, I'm Mark Dunn, and I'm the editor of Portfolio Institutional Magazine, which looks at the investment side of pensions, insurance, and charities. Welcome to this online discussion, which looks at fallen angels. Of course, the fallen angel is a bond that was once considered to be investment grade, but has since been downgraded to high yield. And the pandemic and the lockdowns that we've had to endure have hit some industries hard, and have caused a lot of economic uncertainty generally. Now, I assume this is a good time to maybe pick up a few bargains in this particular market, but am I right, am I wrong? We're going to find out. We've put a panel together to discuss this particular issue, and they're going to do exactly that. They're going to tell me if I'm right or I'm wrong. A good place to start, if we could just start introducing ourselves, and we'll start, as always, at the top of my screen. Manuel, would you like to start?
Yes, thank you for having me. My name is Emmanuel Hayes. I'm a senior portfolio manager at Mellon.
Thank you, Manuel. And David.
I'm David Weeks. I'm co-chair of the Association of Member-Nominated Trustees of Pension Schemes. Perhaps I'll just have one little extra. We've been in existence 10 years this year, and I noticed that Portfolio Institutional has had the same anniversary, so maybe we congratulate each other on our service for 10 years.
Happy birthday, David.
Yeah.
Thank you. Stuart.
Hello, yeah, I'm Stuart Trow. I'm a credit strategist for the European Bank for Reconstruction and Development, and I'm also on their Retirement Plan Investment Committee.
Thank you, Stuart. And Kate?
Hi, I'm Kate Hollis. I'm a manager researcher at Willis Towers Watson. I'm head of traditional credit, which technically doesn't include high yield, but I also run the Credit Smart Beta research operation, which is where we classify fallen angels.
Okay. Thank you, Kate. We'll get to that soon, I'm sure. And Dinesh.
Yes, thank you, Mark. Dinesh Visavadia. I'm a professional trustee with Independent Trustee Services Limited. I sit on several DB schemes, including defined contribution. I chair a master trust from HSBC as well. And in my spare time, I am also a trustee of a number of children charities. Thank you.
Thank you, Dinesh. Good to have you with us. And finally, last but of course not least, Anand.
Hi, Mark. Thank you very much. My name is Anand Quatra. I'm an investment actuary working at the Phoenix Group. I work in the illiquid credit team and work in the origination and risk management of a range of illiquid assets.
Got you. Okay, thank you for that, guys. Thank you. Manuel, if we could just start with you. Is this a good time, as I said there in the introduction, is this a good time to follow a fallen angel strategy?
In our view at Mellon, we believe it is. When we look at the current landscape in the corporate bond market with a large BBB bloat that has been arising ever since the great financial crisis. After 2020, we've seen a large increase of issuance take place, which has further expanded this BBB bloat. We think that's a nice backdrop in this pandemic that we're living in for more and more downgrades to take place. We saw 2020 where there were 200 billion of downgrades taking place in the United States across 50 companies, over 270 bonds. It was an unusual amount, but we think in this pandemic with this BBB blow overhang, 2021 should have increased downgrade pace. Not to levels of 2020 by any means, but even if you have half the amount of downgrades take place, which we approximate, we believe that provides a nice tailwind for investors to really harvest. The one other point I would mention is we did an analysis where we looked at events where historically you look at the energy crisis or great financial crisis, big shocks that take place. And Fallen Angels has really strong returns for the subsequent 1 year. But if you expand that window even further to 2-3 year time periods, you see very strong performance from this asset class. So if 2020, 2021 is any indication of historical performance, not necessarily repeats, but rhymes with the past, we think we're still in a really good time period to really invest in the Fallen Angel space.
Good. Okay, thank you for that, Manuel. Kate, after listening to what Manuel's just said, is he right from what you're seeing?
We would agree. We feel that fallen angels have a structural premium, but most of that premium is in the year or two after a major downgrade event, which, as Manny has just said, we've just seen. While there may be more fallen angels this year, we agree that it's unlikely to be on the scale of last year, and so we think that the premium should come through, this year, next year, and the year after.
Okay, thank you, Kate. Dinesh, with the schemes that you're working on and working with, are they showing any interest in this market? Are they instructing managers to take a look or on a fact-finding mission to find out if there's any value there?
I think the experience is a bit varied, so we mustn't put all the pension schemes in the same bucket. Okay, so the experience is varied. So some schemes which are reasonably well funded are not even looking at this because they don't need to take so much risk. So that's quite helpful. I mean, I have a scheme where we look at our asset allocation through the risk attribution lens. And certainly we have looked at this strategy before and said, is there a value in that or not? And is there a space for that? Because at the end of the day, we're trying to manage the risk of the entire portfolio. So I think we've had some good discussions on that. But there's always a competition with the high yield bonds as well in this space. Mm-hmm. So you start to think whether it's possible. But I think more importantly is that because the opportunity after such an event is only for 1 to 2 years or 3 years at the most, I just don't think there is the agility in the trustees' decision making to take advantage of this so quickly. So by the time you actually do anything, the opportunity is only half there. So often it gets ignored, and that's an issue, I think, from a trustee standpoint, to see how we can get a better governance framework there.
Okay, that's an interesting one. Interesting. Okay. Stuart, you're a man who set credit strategies. Is this a good place to snap up some bargains at the moment?
Well, I suppose the way we would look at it is that we've had quite a few downgrades, which has sort of kind of seeded the market without necessarily defaults getting out of control, or certainly into the sort of to the levels that we might have been expecting perhaps a year ago. So yeah, so it's sort of quite fertile ground for that. And I think added to which that the high yield space in general hasn't quite got back to where it was before in spread terms. So that creates a bit of value for people who look at spreads rather than yields, whereas sort of the triple B space by and large is back where it was. So yeah, so on a relative value basis, certainly more enthusiastic about fallen angels than a lot of areas on the curve.
Interesting. And David, follow question on this one to you. What are you hearing from your members? What are you hearing from your members on fallen angels? Is there any interest there?
Yes, yeah, you rightly highlight that we're not direct investors like the other members of the panel here. We're a trade association, so we represent the members. Our members, we know from a survey that we conducted late last year, rely very heavily on the experts to advise them on these things. In terms of sort of perspective, like Dinesh, about 2/3 of them are defined benefit scheme members. They tend to be at the top end of the trade, so they're a bit cautious and reserved in their approach. But I think the short-term and long-term factors they consider, firstly, in terms of short-term, yes, diversification to spread risk, and secondly, transfer requirements, so liquidity requirements may be needed. Those are the two sort of short-term considerations that they'd view fallen angels. Longer term, the picture seems to be that by and large they do seem to have their strategies in place and tend not to be looking for immediate short-term shifts in it. And the third thing I think I'd add that is high high in their consideration is how will the regulators view investments in fallen angels, in particular, of course, the pension regulator, the FCA. What will they view? I think those will be sort of high in the minds of our trustee members when they consider the evidence that the experts who you have before you today put forward their perspectives.
Gotcha. Thank you, David. Of course, you are one of our experts, of course. Anand, now you're an insurer, so your preference is for investment grade debt. Now, if something was labelled investment grade, but it was in trouble, is there any sort of way that you would consider investing in something that might become a fallen angel?
Yeah, that's an interesting question. I'm probably going to give a very different perspective than some of the other views we've heard, and that's strictly speaking from the viewpoint of, you know, somebody who looks at an annuity book. We're heavily regulated by the Solvency II environment, and we do have to follow relatively conservative buy and hold strategy. So in our world, we are actually penalised by defaults and downgrades. We are actually protected from spread widening, so we don't lose out or don't gain necessarily when spreads widen. And when it comes to sort of looking at triple B risk, we are actually extremely cautious. You know, we have very low appetite for triple B minus type risk, for instance, because if something does get downgraded from investment grade to the fallen angel high yield space, our capital requirements increase substantially. So we have very limited appetite for taking that risk, and it's quite interesting. One of the you know, we do come across various opportunities in the triple B type space, and sometimes opportunities in the single B space. And the only way we would sort of sometimes consider investing in them if there was like a solid wrap or credit protection associated with that investment. For example, if there's a highly rated sovereign or multilateral development bank like the World Bank guaranteeing the debt, so you're sort of almost transforming the credit rating from, you know, triple B status or single B to triple A status. That's the way we would look at these kind of opportunities, so that we are protected from the credit risk.
Thank you. Yeah, a very different perspective there. Thank you. Manuel, going back to you, what you said, I mean, have you taken advantage, have you been adding to your interest here, your exposure here? What have you been investing in, if anything, in this market recently?
Yeah, so I manage both investment grade strategies, high yield, and fallen angel specific strategies.
Yeah.
I would say on the high yield and fallen angel side, the short answer is yes. We have been adding to fallen angels. I mentioned before, there are a lot of opportunities taking place month in and month out. Every single month over the last year, there has been a downgrade by some company, except for January, which was unusually quiet. But even as we speak today, there are downgrades taking place. 2 issuers being downgraded this month across 3 bonds. So for us, we feel that there are more opportunities as these bonds are downgraded. The biggest appeal for us is the discount that they come into the high yield space at. What we see in credit markets, especially in my seat where I could see both sides of the spectrum, IG and high yield, it's an inefficient market structure. It is bifurcated. You're either an investment grade portfolio manager or investment grade analyst or investment grade trader, or you're a high yield manager, trader, analyst. There aren't too many places where you have, you know, synergies across the whole spectrum. This causes inefficient market structure. So as previously mentioned, there are guidelines taking place where you have to force sell because of capital constraints, indexers. They're just not looking at it from that same lens, and it's not in their index, so they force sell. And so you could see quickly forced selling causes these discounts, meaning these bonds are coming into the high yield investment grade or high yield universe cheaper than they should from a valuation standpoint. So for us, we're always looking to see what kind of discounts can we pick up as these bonds are forced sold. And depending on that discount, we'll scale accordingly for all the opportunities of the downgraded universe.
Okay. You talked there about forced selling, of course, and they're all sold for a reason, or downgraded for a reason. So could you get into a little bit more detail about how you would approach a new fallen angel has come across your desk? I mean, how would you look at it? How do you seek to capture alpha from it?
There are a lot of different approaches. We've seen across the spectrum from a traditional high yield manager, you might pick one or two bonds specifically on the curve, depending on the company, and then you just buy that bond or two here and there. For us, we take a different approach. We use more of a quantitative, systematic approach where we're looking to harvest a diversified profile of fallen angels across our fallen angel strategies as well as our high yield strategies. And for this, allows us diversification, not too much idiosyncratic risk, micro bets along each of these downgraded bonds as they come in. We feel from a portfolio design perspective, it allows us to harvest this discount, the structural premia that's out there.
Okay.
At the same time, be able to actually buy it and implement it cheaply.
Good, thank you. And Stuart, what about you? How do you think that investors should navigate these particular markets? Because as we said, they have been downgraded for a reason.
Yeah, but as Manuel was saying, there is a pretty bifurcated market on these things, and that creates the whole fallen angel thing, if you like. I mean, so basically it is a type of arbitrage, and what you'd be looking for are returns that you can't get from the general double B space, because basically people are afraid of the funding requirement, or simply don't want to be around a name that's been associated with a lot of bad news. But whilst you're still in the double B space, that's not a million miles away from the bottom of the triple B space in terms of actual credit quality. So as long as you're prepared to do the work and sort of sort the wheat from the chaff, you don't want to be buying something that's double B now but it's about to be single B. But generally, by and large, there are signs that that's happening. So it's a relative value trade as much as anything else.
Okay. And Kate, I did see you nodding along there. Anything like to add there to what Stuart and Manuel said?
Yes, as I said earlier, we think that the fallen angel premium is structural. It's created by the way investors react to this artificial break between investment grade and high yield. And so therefore, because it sets up structural cheapness, we think as a strategy, just to keep that process running, will earn you excess returns. I hesitate to say alpha, but excess returns over the long term. But it'll be concentrated in periods like now, where there's just been a large wave of downgrades.
Gotcha. Okay, Anand, you're not investing in this market, but from what we've heard from Stuart, from Manuel, from Kate, there's quite some bugs we picked up there. I mean, how would you navigate it? I mean, you do deal with liquid stuff, I know, but how would you navigate it?
I think in this case, I mean, I broadly agree with what some of the views which we heard earlier, but I think ultimately it's when you see these across the desk, it's really just integrating a range of concepts surrounding how you would manage risk and return. So, you need to have rigorous stock selection here, especially in this space. There is heightened risk. I think we need to ask why it's been downgraded. Was it part of a sell-off, or is there a general reason? Is there a general weakening of fundamentals? Was it actually an angel to begin with, or was it a less healthy company? You also need to, I think, also have some of your own internal machinery lined up, because sometimes if these opportunities are presented due to volatility, you need to be agile, being able to take advantage of any sort of temporary dislocations, maybe things we saw last March, quickly before the opportunity disappears. Another thing just to mention here is also, and this is something we're quite familiar with, is managing downside risk. So if you are in this high yield strategy, it's just having clear risk appetite parameters, like capping your allocations to lower ratings like single Bs, etc.
Gotcha. Thank you, Anand. I want to move on now to defaults, because obviously the defaults in investment grade all the way down to high yield, of course. But we would think more so in sort of the fallen angel space, high yield space, that that's more possible, and that's why they're paying so much to you. So how do you navigate default? How do you try to keep defaults at bay? Does anyone want to take that on? You want to come in there? Oh, Kate.
Yeah.
Yeah.
I mean, there are very few investment grade companies that go smoothly from investment grade to default. And when that happens, it's normally associated with fraud, like Wirecard, like Steinhoff. But I'm not saying it won't happen and it can't happen, but generally downgrades are associated with financial or other operational activities that the rating agencies are able to monitor, and there's normally fairly good signs that something is about to be downgraded. It's not everyone's being caught completely on the hop, but yes, certainly fallen angel strategy is much improved, we feel, by having a screen for companies that are suddenly downgraded by several notches, because it's a signal that there may be something really nasty hiding in the woodshed there. I'm not saying it's a perfect defense, but it's better than nothing.
Could I put a bit of flesh on that one?
Yes, of course.
Mark? Our members, I think, found very helpful your guide to some fallen angels in your November last year edition, and sort of putting flesh on the bones, as it were. I mean, the sort of vibes that came back were, you mentioned Marks and Spencer. I think they see their long-term decline in market capitalization, which clearly is a worry. Poor ranges of merchandise, which is probably a worry. Reliance on an outdated property portfolio, which is a bit of a worry. So I think they might have sort of reservations on that. British Airways, by contrast, short-term turmoil, but probably some bounce back seem to be the sort of perspective on that. So probably a bit better than that. Next, the retailer. I remember when market capitalization of Next was the same as Marks and Spencer. Now it's 4 times as high as Marks and Spencer. So probably we expect to see some sort of recovery from that. Virgin Money, you mentioned. I think there was a feeling there that maybe brand image is a bit tarnished compared with what it might have been in previous years, so that there may be a longer term problem there. And then ITV, you mentioned, finally, decline in television advertising revenue, probably a more serious thing. So I think putting flesh on the bones in the way you did with the specific examples was very helpful in sort of guiding trustees into the sort of factors which more generic in character.
Thank you, David. Thank you, David. Manuel, listening to Kate, it's like you get plenty of warning if a default is probably on the way and get a good feel for it. So is this something quite low down your list of priorities, looking for defaults? Are you looking at other things as well?
Absolutely. Risk mitigation is key. I think it's key for any part of the credit spectrum. And fallen angels specifically, it is a higher quality segment. You have roughly 90% of rated in double B space. When you look at defaults in this particular space versus broad high yield, it is significantly lower than the broad high yield market. When you look at historical numbers over the last 15 years, fallen angels have had 0.6% defaults on a par weighted basis.
Okay.
When you look at broad high yield for some of these broad indices, it has 1.61% on a par weighted basis over the last 15 years. So you could see it is less than broad high yield since it is higher quality. So you're in a higher quality space, which is great. But yes, you always have to mitigate what the market calls falling knives, or these big jumps that happen from IG to something very low, much lower. At some point, the structural premia, the value that's initially presented goes away. And then these companies that are rated double B or single B at the time, they may potentially continue to deteriorate. And so you have to start looking at fundamentals at some point and saying, is this company have high leverage and continuing to lever, low profitability and continuing to deteriorate over time versus their peers? And so you have to have these mechanisms in place to monitor that and mitigate that exposure.
Of course, the point is as well that these are unprecedented times in the middle of quite a deep downturn, and there's a lot of uncertainty ahead. So what impact that has on a risk analysis? Because I say you talked about falling knives there. I mean, how long is this going to continue? I mean, we talked there about British Airways and they might come back, but when would that be?
Yeah, timing's a big question mark. I think in this pandemic, nobody has an answer as to when things will stabilize and companies will rebound. I know a lot of companies have had very unique opportunities to raise capital in this very low funding world that we're in. Funding costs are at all-time lows, and we've seen that last year and this year. So that's a big question mark. For us, what we are excited about is the volatility component that you mentioned.
Okay.
We take a quantitative, systematic approach, and for any sort of quantitative approach, anytime you have periods of volatility or dispersion that takes place in a universe, it's really good for models to really differentiate quote unquote winners and losers, or this left tail of this universe. So for us, volatility is good. We like volatility and we like downgrades, so both of which is helpful for our approach.
Good. And Dinesh, with the schemes you're working with, I mean, would they have sort of the appetite to use such volatility?
Well, I'm not so sure. It would again vary with the type of scheme and where the scheme is in its journey across. But what I would say is that, and what I'm hearing more amongst the trustees is that if you think on the one hand, the pandemic and everything else is causing uncertainty in the markets. So secondly, we then hear on the other hand, some of the companies valuations are rocket high, right? Some of the new tech companies coming in. So in trustees' minds, they think this is a recipe for disaster, right? And therefore they shy away because they think this is just beyond their risk spectrum that they want to deal with. So that's a big challenge, I think, from a trustee standpoint, to get their mindset over. So it's probably, I think this has an opportunity and this is a good asset class. But given the timing today, I think a lot of pension trustees might just sort of shy away from it, just because it is in their minds is very clear that there's only one way for this market to go. With high valuations and uncertainty in the markets, what happens is things will just go pear-shaped. So that's how I feel the conversation that happens amongst the trustee boards. I do have a question, if I can, please.
Yes, of course, yeah.
And I was quite interested in saying, firstly, to what extent are the downgrades, not just based on the valuations, but to what extent have they been exaggerated by poor ESG credentials, right? So it's all about valuation. So, and that's another very important subject for pension trustees is ESG, climate change is all important. So there could be companies who are not great at transitioning to this new low carbon economies.
Yes.
How has that exaggerated, and therefore their option or their opportunity to actually bounce back is probably quite limited. So it'd be quite interesting to understand from people who actually are involved in investing to make a comment on that.
Kate, are non-financial factors you think may be influencing the credit rating here?
They may be influenced. I mean, I'm not a credit analyst. Let me preface it. And also, WTW does not invest in securities. We work with managers to invest in the securities for us. That having been said, Dinesh is absolutely right that some of the issuers that have been downgraded recently do have lower than expected ESG credentials, but that is not so much an ESG effect, I would say. It is a function of the fact that, for example, the oil price very briefly traded negative last year. And so Occidental, as an example, that had undertaken a very aggressive merger, a year or so prior to that, its financial metrics changed. Now, this is completely different from, say, thermal coal companies at the bottom of the CCC spectrum, where ESG is going to have a very different effect. And the industry, it is quite possible to say, is in long-term decline. I mean, there are other fallen angels where the industries are in long-term decline. You can think perhaps of some of the US retail, which is suffering, and UK retail too, which is suffering enormously relative to online competition. But that's not so much an ESG thing. But yes, avoiding issuers with what could be long-term ESG headwinds, so they're less likely to bounce back and more likely to decline gently, is probably a good idea.
Thanks, Kate. And Stuart, are ESG factors playing a role here? Is it not just about the finances? Is it about the wider sort of footprint and impact?
Yeah, I mean, I suppose, to some extent, as the others have said, it's sort of, there are structural changes and the pandemic has accelerated that process. So, I mean, like with the airlines, being able to have conferences like this and bond roadshows and stuff like that, people kind of weren't quite ready for doing them online, and now they are. So it's that has a knock-on effect right the way through. I mean, I suppose the thing slightly nervous about with ESG is that it's very difficult to quantify it. I mean, it's obvious if you're a coal miner or what have you, but if you're more in the middle, and perhaps you're in a story where your ESG rating wouldn't be great, but you're able to improve it, or you're a very green company in inverted commas, but there's little you can add to that story. I don't think the market and regulators are quite clear on what direction they want to take this. Is reward people for improving, or just only favour green industries? And I think that's led to a lot of confusion about what is actually green. So, for example, you get a lot of I don't know, sort of particularly in the high yield space, private equity owned, I know a couple of articles have featured that recently, a couple of private equity owned firms focusing almost exclusively on green transactions. And the cynical part of me thinks, well, they're just after tighter spreads. But and if you get a more rigorous broom judging these ESG standards, that you may be in a more difficult situation than you might have been with a vanilla bond.
And Manuel, of course, you on the ground, of course, this is your bread and butter, you're trading in these things. So is ESG part of your credit analysis? It's factored into your decisions when you're sort of buy or sell?
Yeah, ESG is important. I think clients are demanding it. I think investors, asset managers alike are seeing how important it is, and that's great. It should be. Environmental, social governance issues are highly relevant in today's market. In terms of the investment itself and the ratings, I'd break that up into two different points of views. On the rating side, it does not heavily influence a rating agency downgrade. Rating agencies are still very traditional. They'll look at fundamental balance sheet information, leverage metrics, cash flows, more traditional metrics. Hopefully at some point, ESG does become more relevant to these rating agencies, and they do become more important from a non-balance sheet perspective. But as of today, they still look at those traditional metrics. So as these bonds are downgraded, it's purely based on that. That's what causes the current market.
Rating agencies, Mark, are creeping very high up on the agenda for trustees to get accurate data on these things. If you take E, S, and G, E is the one which is sort of tends to be top of the list. Talked about BP, Shell. G is one which is sort of creeping up. I suppose the recent examples are Tesco, the accounting problems that they had with that. And the other one, of course, which came out of the blue, was Rio Tinto blowing up the Australian prehistoric things. Who would have thought that would sort of creep onto the agenda, bringing in G as a factor in E. I suppose the other one, which is sort of high on people's agenda, is the tobacco sector. When do we bail out of tobacco? Smoking is gradually reducing, but on the other hand, the dividends are good. So, when do we decide that we ought to pull the plug? Seems to be the issue there.
Yeah.
Arland, do you think we should be paying as much attention to rating agencies? I mean, in the past, we look at the last crisis in 2008, there were a lot of things that they missed, that they got wrong. How much emphasis do you put on them?
Again, something where we will come across this from a different perspective.
Yeah.
Our regulation does encourage us to, when we rate assets, to be consistent with how an external rating agency would rate assets, which is why we will give quite a lot of credibility to what a rating agency will come up with.
Mhm.
So yes, I think again, just probably in this space, it's just again about balance. So yes, you've got to pay attention to the rating agency's view. They'll have done a lot of fundamental analysis, but that's just no replacement for doing your own scrutiny and analysis on these risks, because you are operating at the higher end of the risk spectrum, from the perspective of some investors. So I think there is significant onus on the investor to really understand, what's driving the fundamentals, why has this been downgraded, etc., etc. What's the prospect for a reversal? And that's from our own point of view as a buy and hold investor, we are also getting a lot of scrutiny from the regulator, not just to rely on what a rating agency says, but to form our own internal views and essentially own the risk.
Gotcha. Dinesh, when your managers report to you or to your estimate committees the various schemes you work across, do you want to hear how they factored in the rating agency's opinion, or is that something maybe lower down your priorities? And where does it sit?
No, I think it's important. So I think as an investor, you want to try and take as much information from the market as possible. So of course you want to, the rating agencies are there. They've been there for a long time, and they particularly focus on more of the quantitative assessments. So that's fine. But there are a lot of commentaries out there, a lot of fund manager research reports that go there. There's consultants who actually give you some opinions and views as well. So I think as an investor, I think we do pay attention to rating agencies, but we also think that there are more people that we should listen to as well at the same time, which I think is the key here, that no one person is going to tell you the full story. So it makes the life of a trustee a bit more difficult to get more information, but I think that's the right thing to do.
Gotcha. Thank you. And Kate, of course, as we heard from everyone here, we're all doing our own assessments, of course, and relying on our own research. But I mean, how big do you think credit rating agencies' research should be when people are trying to build up a picture of a particular bond, perhaps?
You could go on doing research forever, and you will never be finished.
Yeah.
Because you will never have perfect knowledge. I mean, not even the CFO of a company has perfect knowledge of its finances. So there reaches a point at which you just have to say further effort is not going to be rewarded with further information, and you have to draw a line. But it is knowing when you've reached that point and you have answered the questions and identified the potholes that you can feel confident you've stopped, and then you have to rely on your judgment and monitor it to see if you were right. I mean, I don't know whether Stuart would agree with that.
Yeah, I guess.
Stuart?
I guess the issue is I mean, not just fallen angels, but high yield in general. When one of the reasons why people are more comfortable with investment grade is because things are a bit more homogenous there. If you've got a single A rated company, by and large, they will trade pretty much in line with each other, whereas you get a far more dispersal around sort of mean credit spreads in high yield. And that provides an opportunity, if you're prepared to sit down, do the relative value work, but also do the fundamental work to see whether the apparent relative value is real or not. And I mean, at the end of the day, of course, it's the rating agencies that effectively create the fallen angel arbitrage anyway. So.
Yeah.
Okay. Yeah.
Mark, if I can add one comment.
Yeah, of course you can. Yeah.
Rating agency topic. This is something, especially when you look at it in the investment grade universe, they do lag. They have improved over the years. Their metrics are getting better as data is becoming more relevant, accessible, easier to digest, but they do lag even in today's market. And we see this. We looked at analysis of all these fallen angels as they were being downgraded over the last 15 years. And what becomes quite obvious is even 6 months before official downgrade of bonds from investment grade to high yield, you'll see the market already pricing it in. The market, for some degree, is more efficient, understands information, faster moving, easier to digest. And so you'll see underperformance of these investment grade bonds as they start slowly getting migrated. The market sees it and prices that in. So to that degree, the market is somewhat more efficient than where the rating agencies are. I'm not saying they're bad by any means. I think it's just a little bit slower moving.
Gotcha. Okay, thanks for that, guys. Manuel, staying with you, liquidity. I mean, how are you accessing liquidity in this market?
I'm an outlier, so I'll just come out and say that up front to the panel here. I think liquidity has never been better in fixed income markets. And I say that with a caveat. I think it depends on how you access it, if you know where these pockets of liquidity are, how you created and designed it. When you look at fixed income markets, traditionally, it's been a very illiquid segment, especially as you get into the high yield markets. Traditionally, 10 years ago, you're picking up a phone and calling a broker and you're trading by appointment.
Yes.
You look at the market today, it's evolved very fast, which is exciting for me being a fixed income portfolio manager and focusing on the trading component of it as well. The bridge for us has been the ETFs. ETFs have been a huge catalyst to really bridge the gap between the great liquidity you see in the equity markets and fixed income markets. And so these ETFs and the growth of the ETFs have really bridged that gap. Is it anywhere on the same level? Absolutely not. But it's evolving and it's getting better. And that's exciting if you know how to access it. And that's a big if. Still, no knock on others. Some people are still calling brokers, and there's always going to be a need for that. They do have the balance sheet and they can make markets on specific bonds you may be looking for. But if you know how there's this larger ETF ecosystem that's being built into today's fixed income markets. And if you can access it, you could get bonds cheaper. You could actually find the securities you want, which is very rare. And you could do it in size and scale.
Thanks, Manuel. Has anyone got anything to add to what Manuel said there regarding liquidity?
Yeah, just add, Mark, on liquidity. I think trustees are very aware of the need for money for transfers at the moment. The House of Commons, as you know, DWP Select Committee has been turning the spotlight on scams and transfer funds. I think that trustees will be very aware of what's going on. They'll also be aware of the risk of getting out of investments if a fire sale is necessary. So I think the liquidity requirement, yes, will be high on the list.
Good. And Dinesh, I think was to come in there.
Yeah, let me just make a comment. I mean, I just wonder how much of a issue liquidity is, because there's so much money being printed by the governments in the world.
Yes.
All right, so there's so much out there. So the opportunity cost of actually going in this is pretty low obstacle I see. So I haven't worked out in my mind whether liquidity in this market is really an issue or not. So given so much money is flooded in the system, in the economies, there has to be liquidity parked somewhere, and every sector of the market will have a reasonable amount of liquidity to get in and out. That's my judgment, but I am not as close, and I don't deal with that on a daily basis, but maybe others who are closely involved could probably comment.
I think our members ask the questions. We look to Dinesh and his colleagues to give us the answers, point us in the right direction.
Oh, no.
Yeah. It is interesting what you said there about central bank intervening and what they're doing and how that's changed your perception or shaped your perception. Has anyone else got a comment to make on what impact central banks have had on the fallen angel market?
But one of the issues, not specifically fallen angel, but fallen angel sometimes perhaps helps to address it to an extent, is that actually because rates are so low and by and large because of the uncertain economic outlook, people have tried to keep their funding requirements to a minimum. Actually, there's not as much supply out there as you might hope. So investors have been running around trying to sort of find pockets of activity, pockets of liquidity and stuff like that. And by and large, sort of issuers are keeping their heads down to an extent. And if they are issuing, they're often doing it in tandem with tender offers or, you know, pre-funding several months or years hence. So, you know, I think what we're beginning to see in terms of new issuance of high yield, but new issuance for the whole credit market, is that we've cannibalized potential issuance for the next year or two now, and we might actually be in a situation where fallen angel strategies are ideal for this scenario, because people are scrapping around for anything to buy and anything with a bit of spread.
I think that question falls into two parts. I don't think central bank buying has actually done very much, because I don't think they've bought very much at all. And as far as I'm aware, the ECB hasn't bought any high yield. The Fed's bought a bit. What was a huge game changer, though, and made an enormous amount of difference, was the effect of the Fed's announcement on sentiment. And it was quite interesting the way they crafted that announcement, that the issues that had just been downgraded, including Ford, were clearly eligible for buying. And at the time that they made that announcement, when the market was in full panic mode, fallen angels were just being sold off left, right and centre. And on the day of that announcement, it stopped and it went into reverse, and fallen angels outperformed native high yield by a really significant amount that in the next 6 weeks. So from that point of view, it did a lot for confidence. It did very little in terms of actual dollar and cents, but please disagree with me.
No.
Absolutely.
I mean, Manuel, how's this changed? How's this altered your approach in any way?
Yeah, I agree with Kate. I think it was needed. I think the Fed needed to step in and just stabilize not only bond markets, but the entire risk market spectrum, including equities. Liquidity was purely almost evaporated. Markets were dislocated. Companies couldn't issue any sort of debt if they needed to tap into capital markets at all. So the Fed coming in did provide a floor. And even though they didn't, to Kate's point, didn't really buy much at all from the actual dollar amount, it did show the market that there's a willingness of the Fed and global central banks to potentially step in when needed. So when we look at, they officially closed their books on the Fed as of December 31st of last year. So they're not buying any more corporate debt. That has stopped. Okay. They will now hold and sell accordingly, but they're not going to proactively buy anymore. Is that a risk or concern? No, I don't think so. We've already seen the willingness come out. So if markets go back into some sort of disarray in 2021 or further, at least in the market's mind, there's always this backstop that the Fed or global central banks will come in and just provide that to the markets and stabilize them.
Anand, you deal with quite liquid stocks. I mean, what impact has it had on you in your end of the market?
You're talking about the central bank buying?
That's right, yeah.
Yeah. I mean, it's the spread tightening in the last few months, whether you call that due to central bank buying or general improvement. The narrowing of spreads on the investment grade world is putting is intensifying the search for yield. We don't look at the fallen angel space for reasons I discussed earlier, and it's just sort of intensifying the search in private credit and illiquids across the investment grade spectrum.
Okay. Ganesh, I think you're on mute, I think.
No, I'm still here.
No, you're still there. Sorry.
I'm still here. I'm listening.
I think you're trying to say something.
No. I think I've been a bit pessimistic about the opportunity of fallen angels, but I think most of the pension schemes are positioned to take advantage of this, and that is through their credit portfolios below the investment grade. So they invest in a lot of, just to get the yield, they invest in below investment grade credit opportunities. And I know that some of my pension schemes have managers who look at deep value, distressed debt, and high yield at the same time. And I'm sure they take advantage, and they will take advantage of that in the next 12 to 15 months.
Okay.
So I feel quite positive about this opportunity.
Okay, gotcha. Okay, we are time is pressing now. So actually, one final question, if we could. We've talked a lot about where we are and what was happening last year and what we think is happening this year. I mean, how do we see the future of this market? Because I did mention at the outset, there's a lot of uncertainty. We don't actually really know when things are going to return back to normal, when some industries are going to take off and be back on their feet again. So, of course, I think a lot of uncertainty could make things deteriorate. But how do you see the future of the market potentially in the next 12 months? Manuel, could we start with you? Could you give us your thoughts?
Sure. We're very optimistic on the fallen angel space. We think that the combination of this large BBB minus bloat, 900 billion in debt outstanding, we've never seen levels like that. On the fundamental side of these companies, leverages are at all-time high. And then you combine these issues and concerns with this pandemic that we're all living in, that causes uncertainty. Business models are changing. Companies that maybe had high leverage metrics in 2019, maybe that doesn't exist in today's world. So companies' models have to change. So all these question marks and uncertainty and topics that we're bringing up here excites me. From a cynical side of things, I'm looking forward to every single downgrade that happens. Now, that's not good for our economy by any means, having companies being downgraded and having these issues. But from an investment manager side, if you're going to force sell these bonds that are in the IG space at huge discounts, well, I'll be happy to take the other side of that and harvest that opportunity set cynically, but in all goodwill.
Thank you, Manuel. Arnold, are you expecting to see more investment grade debt fall off your radar into Manuel's side of the park?
I think we're naturally cautious. Yes, I mean, we do have a policy of being cautious on BBB, and this environment is just making us more cautious. So, you know, I would argue, yeah, there is an expectation of certain sectors continuing in that downward trajectory. You know, equally, we are seeing signs of some recovery as well. So, you know, the way we sort of navigate that is we are naturally drawn to the safer, less cyclical sectors. And so maybe the things which are sort of navigating into that territory are the things we just don't focus on.
Okay. Thanks, Arnold. And Stuart?
Yeah, well, I mean, I'd be sort of generally quite positive, obviously with the caveat that we don't see a generalized risk sell-off, because I think, you know, fallen angels are probably an asset class that's very interesting in the context of a risk rally. But, you know, the couple of things that would concern me are that people are pressing for longer tenors at the moment. And, you know, especially if you invest on a yield basis, you are going to get killed if you know, benchmark yields turn around quite quickly. But as things stand at the moment, you know, with sort of downgrades not necessarily filtering completely through to defaults, yeah, I think it's quite an attractive space, you know, but that's in all other things being equal sort of scenario.
Okay. Whose phone's that, I wonder?
I'm sorry, that was my phone.
David.
Background. Hopefully it will be cut off.
Yeah.
And Kate, does anything concern you over the next 12 months?
Not about the next 12 months. There is one thing I would say about fallen angels in general, though, is that you need to think about them very carefully at the end of a long risk rally, and we're nowhere near that at the moment. But it can be a very concentrated strategy. Downgrades are often concentrated in one or two sectors. And at the end of a long risk rally, when there have been very few fallen angels, there have been a number of rising stars, and there have been a lot of maturities, you can have a fallen angel strategy that's really, really concentrated by name and by sector. And you know, at that point, you need to take a really hard look about whether it's something that you actually want in your portfolio, whether it's still doing the job you wanted it to do.
Yeah, that's good. Thanks, Kate. Dinesh, you said that you were positive. After hearing what we've just heard, has that changed?
Yeah. I tell you what, the most positive thing I've heard is from Manuel, Stuart, and Kate, really, that there is a dislocation in the investment grade and the fallen angels market, right? And if there is a recognition, then I'm sure the asset managers will do something about it. and they'll get better quality research, better quality opportunities, and it will be much more beneficial for the investors at the end of the day. So it's very encouraging, I must say.
Good, Thank
Can
you,
I
Dinesh.
add to two groups who I think the trustees will be interested in? One is going back to the point I made at the start about regulators. How will the regulators view this market? And secondly, the number of specialists. Have we got enough specialists to navigate the new or newish sector? Will be high in their minds, I think.
Gotcha.
Yeah, that's why we have Emmanuel here. That's the key.
Yes, yes. Gotcha.
To
Okay,
your
guys,
services.
we are up to the hour. So if anybody has a final comment they wish to make. Nope.
Yeah, thank
Okay,
you.
then, guys. Thank you all very much for joining with for this discussion, which quite timely, I think we'll agree from what we've just heard, and it will be interesting to see how this evolves over the next 12 to 24 months. I thank you all. I would especially like to thank Melon, our sponsor, for making this happen. Thank you very much, guys. Goodbye.
Thank
Thank
you.
you.
Bye.
Thank you.
Bye.
Thanks, guys. Thanks for your time.
Bye.
Talk